Welcome back to Protecting and Preserving Wealth. I am John Gay, joined as always by Bruce Hosler, Jason Hosler, and Alex Corey of Hosler Wealth Management. Gentlemen, always good to be with you.
John, it's good to be with you this morning.
Hey there, John.
Good morning, John.
I know one of the things that you specialize at Hosler Wealth Management is taxes. And there are some new tax laws that have gone into effect now that we're into 2026. And Bruce, I know you've got several of these you want to focus on today that really could have an impact on our listeners' bottom line. Where do we start?
Well, there's two of them that we want to talk about today from the One Big Beautiful Bill Act. And then there's two other new tax laws that I think are applicable. One that was passed in 25 and the other one was from prior, the Secure Act 2.0 in 2022, but it became applicable this year. So the first one I want to start out with is the One Big Beautiful Bill as permanent. Now, there's nothing permanent in tax law until there's the next election. but we have permanent tax rates for both income taxes and for estate taxes. And that is really good and very important. And especially for our clients that are trying to move to tax-free, the net benefits for IRA to Roth conversions are more attractive for highly taxed Americans than just about any other time.
Yeah, making that permanent, it is just until we have a change in Congress and president, but they have to actually get that passed. They have to get that signed off by the president to put that into law. So we do have an extension with these lower tax rates. It makes long-term Roth conversion planning more attractive, and you have hopefully a longer period of time, probably at least through the current administration at the very least, to be able to utilize these lower tax rates that were set to expire at the end of this last year. You can spread out over the number of years your conversions, and it's going to affect people that have potentially taxable estates in the future. That Roth IRA is now much more valuable because when it gets passed down to the heirs and they're able to take that out tax-free and stretch that out for 10 years under the Secure Act, they're going to have less overall tax drag on the estate passing to the next generation.
And Jason, there's another twist here that I want to show our listeners or point out to them. Folks, if you have potentially a taxable estate and you have big tax-deferred IRAs in there, those potentially could be subject to double taxation. Well, what are you talking about, Bruce? Well, they're subject to estate taxes at 40%, but then it's going to be subject to income tax at another 30, 40, 50%. You could be paying 70, 80% on that IRA that you left and you didn't convert. If you've converted that to a Roth IRA, at least it's not subject to income taxes in addition to the estate taxes. So it's important if you have a taxable estate, you do not leave those IRAs unconverted. You get those converted to a Roth. Even if you have to pay a 30 or 35% tax bracket, it's better to do that while you're alive. Now, the next thing I want to talk about, Alex, is some restraints that we're going to have in the tax code regarding the deductibility of charitable donations. And in our last podcast, we talked about, QCDs. Well, Alex, this new tax law change affecting the deduction, now it starts in 2026. So beginning in 26, if our clients make a deduction, there's a 0.5% that they can't deduct anymore. Talk to our listeners about this new tax law and how limiting it is.
Yeah, so the word is called a floor. So you have to donating above the floor, again, 0.5% of your adjusted gross income. Okay. So in this example, let's say if you were making $500,000 a year and you made a charitable deduction, the first $2,500 or 0.5% does not get included in a deduction you receive. It's only the amount above that you would get a deduction for on your tax return as an itemized deduction for your Schedule A deductions. So it's really important to know that you don't want to miss those little things in there because this is brand new. So if you are making charitable donations and you are over 70 and a half, then the QCD or the qualified charitable distribution may make more sense for you to do your donations through your IRA as opposed to giving cash or other securities or other assets from your taxable monies.
There's another planning thought that I have, and I want to introduce this to our listeners today. I want to bring it back up. We've talked about donor advised funds before. And the benefit to a donor advised fund is you can bunch your charitable into 1 year. And so instead, if you already have $30 or $40 or $50,000 now with the senior deduction and that in standard deductions, your charitable deductions may not be helping you at all. So if you do a donor advised fund, let's say you have a bunch of stock, let's say you have Abbott stock, and you give away $100,000 worth of Abbott stock, you give it to your donor advised fund, you can have an itemized deduction of $100,000 for that this year. But in 2026, that first 0.5%, you don't get a deduction on that. Well, instead of giving $20,000 a year for 5 years, you give the $100,000 away to your donor advised fund in 1 year, and you only were limited the first year. The other 4 years, you were not limited. Let's talk about on the donor advised funds, just the gift of appreciated assets instead of recognizing the capital gain on those. What's the break there? How does that donor advised fund work?
So this bunching strategy is something that we use with our clients when we are actually trying to get an itemized deduction, because as Bruce said, often with the new senior deduction, the higher standard deduction, the majority of people aren't itemizing anymore. And it's harder than ever to be able to do so. So if you have a number of medical expenses, if you have a big tax bill from the prior year, and it looks like a good year where we might want to do a bunching strategy, the donor advised fund is a great tool for this. Oftentimes we'll have clients that either worked for a company or bought a stock a long time ago that they've held for a long time, and it's appreciated a lot, some Apple, some Nvidia, something like that. And they have a large unrecognized capital gain. So you're able to kill a couple of birds with this stone of a donor advised fund. So number one, when you make that donation, so let's just use for simple math, $100,000. So let's say that we donate $100,000 worth of Apple stock into our donor advised fund. And we bought it 20 years ago and we've held it for a long time, and it's mostly unrecognized capital gain. We now will not have to recognize that capital gain in the future. So one, we're avoiding that capital gains tax. Number two, because we've made that donation, we get $100,000 on our charitable line on the itemized deductions for that year. So at that amount, you're going to exceed the standard and senior deduction, right? We say we give $20,000 a year on average to our charities, our church, everything all added up together. Now that Apple stock is in the donor advised fund, we can go ahead and sell it without recognizing any capital gains and put it into a diversified portfolio so we don't have concentration risk. And every year for the next 5 years, we can sell off $20,000 of that portfolio, make the gifts that we normally do at the same cadence every year. We've just pulled that charitable giving from a tax standpoint from the future to the present to get that deduction, and then we still make those same donations over the next 5 years from our donor advised fund.
So our charities receive their gifts and they don't know any different. They don't pay any taxes. It's beautiful. So John, you kind of, before we started on the podcast, you kind of asked me if these were all part of the One Big Beautiful Bill Act, but this one here, the Social Security Fairness Act, repealed the windfall elimination provisions that the government had on pensions, and they made it retroactive all the way back to January 1st of 2024. So we've had some clients that have already been getting benefits from this. Now, this affects people that have had government jobs, teachers, school teachers, police officers, firefighters, state and local government employees that were covered by a pension, but they were not covered by Social Security at the time they earned that pension. Mm-hmm. And then either before or after, they could have worked and earned enough Social Security to qualify, but when they go to claim, they were getting dramatically curtailed on their Social Security benefits because of this windfall elimination provision. That has now been taken away. And in 2025, the enactment of the Social Security Fairness Act made these benefits available to these workers retroactive all the way back to January 1st of 2024. But here's the problem, folks. You can only go back and claim for 6 months against your Social Security. So if you don't claim, even though you could have had it for a year and a half, you can only go 6 months back. So it's very urgent. If you're one of these people that have been having your Social Security held back, you need to go in and claim on this and get the clock going so you can claim these last 6 months.
I want to underline that, Bruce. I want to make sure I'm understanding it correctly, that folks who had a pension from a lot of those types of jobs you mentioned were unfairly penalized with Social Security until this had been repealed recently.
I don't know if it's unfairly, but it's what the law of the land was.
Fair.
And the Congress felt like it was unfair, so you're justified there. And so they've eliminated it. And now these people fairly, they paid into Social Security. They're going to get their fair share of what they earned in that program. I think it's a great thing, but I hate to see people missing out on a benefit of the law that could come to them.
Now, our clients that we have that were covered under this windfall elimination provision who had already claimed for Social Security, because they'd already claimed, that retroactive got paid out in a lump sum, and then their ongoing monthly generally increased by the calculated amount. So for people who are already claiming, this was happening automatically. But for people who didn't claim because they wouldn't have been getting anything due to it, those are the ones they need to go claim. And it's very urgent that they do so right away because of that 6-month retroactive clock that Bruce was talking about.
Don't want to leave money on the table.
No.
Alex, I want you to talk about our fourth topic here. The Secure Act was enacted back in 2022 about the 401k catch-up contribution provisions. Talk about the changes that are becoming effective this year because of COVID-19. They backed it off a few years, but now there's no more backing this off. This is effective in 26. Tell our listeners about what they need to be aware of if they're high earners.
So if you are a high earner and you're earning over $150,000 a year and you're over the age of 50, okay, you're going to get your catch-up contribution amount contributed into your Roth 401k now. Previously, that money would go into your tax-deferred account. So again, pre-tax money, you pay taxes in the future, you don't pay the taxes now. But now they're requiring it beginning in 2026 for that money to be deposited into the Roth account, which is great. More tax-free money, the better. Don't defer any longer, especially if you're a higher income earner. That's going to mean more taxes in the future. We want you to pay lower taxes now anyways. So be aware of that.
So Jason, why is the government forcing this extra catch-up provision to be in a Roth? What is it they're going to get out of this?
Well, so here's exactly the thing. So for those earning more than 150, that catch-up, which has now been increased to $8,000 for 2026, that $8,000 catch-up, that gets taxed in the current year on your W-2. So the government is forcing those higher earners to recognize that tax now. The government is saying you don't get to defer that till the future. We're collecting that tax on you right now.
So the government is going to collect more taxable income sooner. That's the motivation. It's not because they're good people and they want us to have a Roth. They just want to get their taxable money sooner.
We like that they're going to be going to the Roth, though. For most of our clients, we think that that is going to be the best long-term move. And for your regular 401k contribution, not even your catch-up, we're generally recommending to the vast majority of our clients that they go ahead and recognize the tax on that now, defer that into the Roth 401k, start building up your tax-free nest egg while you're still working.
And I want to point out here, the real reason that I love this, guys, is, and when I say this, that is funding your 401k to the Roth side, not the tax-deferred side, is because this allows you to put more money than ever before. I think it's up to $24,000 this year if you're under 50. $24,000 into a Roth 401k every year. It's the biggest shelter to get into a Roth, much greater than the $8,000 that you can put into a Roth IRA. So you can grow your Roth account much greater working through your 401k Roth.
One other note I wanted to make on that as well for catch-up contributions, also because of the Secure Act 2.0, is that if you're between the ages of 60 and 63, you do get an additional catch-up as well, up to $3,250 more than the $8,000. So just be aware of that if you don't leave any money on the table, that money can be also contributed into your 401k and retirement accounts.
It's just those people in that donut hole, though, right, Alex? Just in those years.
60 to 63.
Yep.
Bruce, don't say the word donut hole because you're going to make me think of health insurance. That's a whole other topic. We won't go there, but I will mention that if anybody listening or watching wants help with their financial planning, and you really got to get expert help and talk to professionals about this, how do they reach you at Hosler Wealth Management?
They can reach us on the website at hostlerwm.com. In Prescott, Jason.
Give us a call at 928-778-7666.
And in Scottsdale, Alex.
480-994-7342.
All right. Good morning, gentlemen. I'm going to go grab a donut. We'll talk soon.
All right,
Thanks, John.
Sounds good, John.
Investment advisory services are offered through Mutual Advisors, LLC, DBA Hosler Wealth Management, an SEC-registered investment advisor. Securities are offered through Mutual Securities, Inc., member FINRA SIPC. Mutual Advisors, LLC, and Mutual Securities, Inc., collectively Mutual Group, are affiliated companies. Forward-looking commentary should not be misconstrued as investment or financial advice. The advisor associated with this podcast is not monitored for comments, and any comments should be given directly to the office at the contact information specified. Any tax advice contained in this communication, including any attachments, is not intended or written to be used and cannot be used for the purpose of 1. Avoiding federal or state tax penalties, 2. Promoting, marketing, or recommending to another party any transaction or matter addressed herein, and 3. Tax preparation and accounting services are offered independently through Hosler Wealth Management Tax Services. Any tax advice provided by tax professionals under Hosler Wealth Management Tax Services is separate and unrelated to any advisory or security services offered through Mutual Group. The accuracy, completeness, and timeliness of the information contained in this podcast cannot be guaranteed. Mutual Group does not provide tax or legal advice. You should consult a legal or tax professional regarding your individual situation. Accordingly, Hosler Wealth Management does not warranty, guarantee, or make any representations or assume any liability with regard to financial results based on the use of the information in this podcast.